Financing decisions, capital structure. So, what are we going to study? Capital structure. In capital structure decision, we are going to study capital structure theories, net income approach, traditional approach, net operating income approach, Modigliani-Miller approach, trade-off theory, pecking order theory. And the capital structure decision, EBIT, EPS analysis. So theory, decisions, EBIT, EPS analysis. Capital structure decision refers to deciding the form of financing, which sources to be tapped in their actual requirements of funds and their relative proportion, which is mixed in capitalization. Capital budgeting, replacement, modernization, expansion, diversification, need to raise funds, internal funds, debt, external equity. Capital budgeting decision for replacement modernization, we have to need to raise funds, and to raise funds, we have to make capital structure decision. Existing capital structure, desired debt equity mix, payout policy. In the desired debt equity mix, effect of return, effect of risk, effect of cash, cost of capital. To optimal capital structure and value of effect of capital and then calculate value for capital structure theories. The following approaches explain the relationship between cost of capital, capital structure, and value of capital structure theories. Capital structure relevance theory, capital structure irrelevance theory. In relevance theory, there is net income approach, traditional approach, net operating income approach, Modigliani-Miller approach. Net income approach. According to this approach, capital structure decision is relevant to the value of increase in financial leverage, increase in financial leverage leads to decline in weighted average cost of capital, while the value of firm as well as market price of the ordinary share will increase. The financial risk increases, cost of capital will decline, but the value of firm and market price of share will increase. Conversely, a decrease in the leverage decrease in the leverage will cause increase in cost of capital and consequent decline in value as well as market price of equity shares. How do we calculate value of firm on the basis of net income approach? Value equals to market value of equity, market value of debt, overall cost of capital equals to EBIT upon value of firm. Traditional approach. It favors that result of financial leverage up to some point. As a result of financial leverage, cost of capital comes down and value of firm increases. Cost of capital comes down, value of firm increases. However, beyond that point, reverse trend emerge. The principal implication of this approach is that cost of capital is dependent on capital structure, and there is an optimal capital structure which minimizes cost of capital. So the traditional approach says that the traditional approach says result of financial leverage up to as a result of financial leverage up to some point cost of capital comes down and value of firm increases. But beyond that point, reverse trend emerge, that is, value of firm decline and cost of capital increase. The principal implication of this approach is that cost of capital is dependent upon capital structure. There is an optimal capital structure which minimizes cost of capital. So first, what happens? There are three phases in traditional approach. First, cost of capital comes down and value of firm increases, and then value of firm decreases, cost of capital increases, and then both increases, everything increases. Net operating income approach. Any change in leverage will not lead to any change in total value of firm. Change in leverage not lead to total value of firm, and the market price of the share as the overall cost of capital is independent of the degree of leverage. So there is no change in the value of firm and market price because the cost of capital is independent of the degree of leverage. As a result, division between debt and equity is irrelevant. As per this approach, increase in use of debt, which is apparently cheaper, is offset by increase in the equity capitalization rate. This happens because equity investors seek higher compensation as they are opposed to a greater risk due to existence of fixed return existence of fixed return on securities in capital structure. Equity investors seek higher compensation uh, as they are opposed to greater risk due to existence of fixed return securities in capital structure. Value of firm is calculated net operating income upon KO. Modigliani Miller approach. Net sorry. Net operating income approach is definitional and conceptual, lacks behavioral significance. It does not provide operational justification for the irrelevance of capital structure. Modigliani-Miller approach provides behavioral justification for constant overall cost of capital. Hanoi approach doesn't provide any justification, but Modigliani-Miller approach provides justification. Therefore, total value and therefore total values for cost of capital and total value for. This approach indicates that capital structure is irrelevant because of arbitrage process. Sorry, which will correct any imbalance. That is, expectations will change and stage will be reached where arbitrage is not possible. So this approach indicates that capital structure is irrelevant because of the arbitrage process, which will correct any imbalance, that is, expectations will change as stage will be reached where arbitrage is not possible. There are two types of Monte Carlo Muller approach. The one is before tax, that is the tax income tax act came in 1961, right? The income tax act came in 1961, right? So before income tax we have 1958 approach without tax and approach 1963 with tax. Okay, the trade of theory. The trade-off theory of capital structure refers to the idea that company chooses how much debt finance and how much equity finance to use by balancing cost and benefits. The trade-off theory of capital structure refers to the idea a company chooses how much debt and how much equity should we use to balance cost and its benefits. This is debt level, right? This is the optimal level debt. Present value of interest shield here. This is value of unlevered form. Optimal debt level. This is cost of financial distress. Maximum value of the form is here. Pecking order theory argues that capital structure decisions affected by manager's choice of source of capital. Managers may use following order to raising of funds. Following orders. Order for raising of fund. Internal financing, debt and equity. Debt equity trade of theory. Pecking order theory. Internal financing and then debt and then equity. This is pecking order theory. EBIT EPS analysis. The basic objective of financial management is to design an appropriate capital structure which can provide the highest earning per share over company's expected range of earnings before interest and taxes. Design appropriate capital structure, highest highest EPS over the expected EBIT. EPS measures the company's performance for the shareholders. The level of EBIT, EPS performance for the shareholders, the level of EBIT varies from year to year and represents success of a company's operation. The level of EBIT varies from year to year and represents success of a company's operation. However, EPS creation ignores risk dimension as well as it is more of a performance measure. Financial break-even point, EBIT, earning per share, debt, equity, Indifference point. Financial break-even point is the minimum level of EBIT needed to satisfy all fixed financial charges, that is interest, preference, dividend. It denotes the level of EBIT for which company's EPS equals to 0. Financial break-even point can be calculated as interest plus preference dividend upon 1 minus tax rate. EBIT, EPS break-even analysis. EBIT, EPS break-even analysis is used for determining appropriate amount of debt a company might carry. Indifference point or break-even point shows that between the two given alternatives of financing, between the between the two given alternatives of financing, regardless of their leverage in the financial plans, EPS would be the same at given level of EBIT. Between the two alternative, EPS will be the same. EBIT minus interest 1, 1 minus T upon E1. EBIT minus interest 2 minus 1 upon T upon E2. Indifference point, number of equity shares, number of equity shares in alternative 1, 2 interest charges in alternative 1, 2 and tax rate. Overcapitalization, where a firm has more capital than it needs, or in other words, assets are worth less than issued share capital. More capital than needs. Assets worth more than its issue. Assets worth more than assets are worth less than its issued capital, and the firm has more capital than it needs. Earnings are sufficient to pay dividend and interest. Undercapitalization. Reverse of overcapitalization when its actual capitalization lower than proper capitalization warranted by its earning capacity. So capital structure is done.